Again, this is just a price index, not an accumulation index. But to work out total returns, you need to take into account dividends. So in this chart, the dark blue bars include the impact of dividends. It shows you how many calendar years have been negative, and really the only major, well, we've had 3 negative years out of 20, which is really quite typical. But this was an unusually bad decline, which is quite abnormal, even in a 20-year period. This chart compares the constituents of our index with the US market. And you'll note that in Australia we have a disproportionate number of financial and bank and insurance companies, forming nearly half the index, which is quite bizarre really, because the economy is much broader and more diversified than that. America is a more balanced index, where financials are a more prudent part. Materials are a very large index component here too, because we're a resource-based economy. Unfortunately, although we're quite good at computing, our IT section is very, very tiny. This chart shows the performance of the market over 20 years, and what we've plotted here is upper and lower bounds to represent where returns should normally be expected to be on our long-run estimates. So the black line is kind of our base, the precept, my base case of where I think fair value for the market should be, and the green line is an upper bound, and the red line is a standard deviation below it. So this is a 95% confidence interval, and you can see that even at recent levels, this actually goes to 31 December. The market was actually undervalued. And it's interesting that since then the market's actually gone up about 12%. So it was a pretty good signal that the market was undervalued. And we'd be pretty much right on the black line at the moment if the last 2 months' data points were added in. So what I might do is have a break for a minute before we come on to the next question. So I have a 5-minute interval.
So you mentioned it's the wrong slides?
Yeah.
The solution side says.
We have the solution slide, but you asked me to say upload this after the lecture,
Oh, yeah,
so that's why I didn't.
that's right.
Yeah.
Oh, yeah. But we lecture from them.
Yeah, we
Okay.
I better turn the mic off. How do I?
Just mute the mic.
Yeah. And how do I stop recording?
Okay, we're going to talk about the next assignment. So the next assignment is about GE, which Mark has already mentioned. So we've put it up here for you. It's due on the 20th of April and submitted through Turnitin. And we're going to be marking the paper on the depth of coverage, quality of insight, succinctness and accuracy of your answers. So your individual paper must not exceed 3 A4 pages with 11-point font size and 1.5 spacing. You can include appendices if you like. So as Mark's mentioned before, GE is General Electric Company, and it's a US multinational conglomerate corporation with diverse operations across a number of industries, including power and water, oil and gas, energy, aviation, healthcare, transport and finance. GE is listed on the New York Stock Exchange, and the company has origins dating back to the famous inventor Thomas Edison. So we've given you a few websites to help you get you started. There's the financials, which are on the New York Stock Exchange website, and there's also the annual report on the GE website. So when you're looking for your answers, just be careful. They do list the GE financials in 2 separate areas. They separate it out into GE Capital and the GE Industrials, and so we are looking at GE Company as a whole. So if you're looking at the GE Capital, you're only looking at a small part of the business. So be careful when you're looking up the financials for GE. And Mark's going to go through the questions quickly with what we're asking you to answer.
Yeah, so this assignment is, this is what an analyst would do. If you're in a fund manager or a broking house, you'd get an assignment like this as a research project. And what the assignment does is step you through all the logical steps you would need to go through to assess a company and value it. And we take you through the steps. So you have to do each step before you get to the next step, basically. So the first thing you have to do with a company like this is look at the business model and try and understand what is the board trying to do. So this company has got a reputation over many, many decades for excellent returns. They have a conglomerate business model, and they operate in a number of key industries that they think they can provide leadership and be really the leading company in that field in the world. And they're particularly strong in aviation, in transport, in health. I think they actually invented the, I've forgotten the name of the machine, an MRI. Anyone heard of an MRI machine when you have an injury? I think they invented that. If they didn't actually invent it, they commercialised it. So they've got quite a diverse range of operations. And they've also got a finance company called GE Capital, which is commercial finance and consumer finance. And if you read through the presentation, they're basically getting out of consumer finance at the moment, which is one of their strategies. There's a little hint for you. Now, I want you to sort of read through the website and the material that Kimberly's highlighted and see if you can discern what are they trying to change about the company from what's been successful in the past, and they'll be quite helpful in your assessment. Now, in question 2, there's all the ratios, and these are just the basic fundamental measures that we're going to explain tonight as we speak now about what are the real measures. Who studied accounting? You've all done accounting, I'm sure. So you all know these measures. You can read a balance sheet and you know what net equity is and this sort of thing. I would warn you net debt for GE is a little bit complicated because they have a consumer and a finance company. So it's a little bit tricky to work out exactly what net debt is. So that's a bit trickier for this company than it is for others. Now, in question 3, we want you to forecast the earnings per share. And I suggest you read the management presentations carefully to get some clues about that. I don't expect you to build a whole financial model. We really just need a sort of an arbitrary assessment of where you think the earnings will go in 2015. By the way, this is a calendar year company, if you get confused. It's not, in Australia we have 30 June balance date. This is 31 December. So if we talk 215, we mean calendar 215. So what I want you to do is forecast the earnings per share for calendar 215. They earned something like $1.51, I think it was, in calendar 14 per share. Now, in question 4, I want you to determine a relevant price earnings multiple based on the lecture tonight and any other information. Next week we'll be talking about valuation too. So you'll need to be here next week, obviously. And question 5 really just takes input from 3 and 4 to work out your valuation. You can state any reasons or arguments in question 5 also. And then in question 6, we just want you to highlight what you think are the 3 most significant risks to your valuation. If you have any questions, you can ask me next week once you've had a look through it all. Hopefully, we've never set this particular assignment before, so there might be a glitch or two. If you get stuck on an issue, just say I've made this, in your answer, just put in, underline I've made this assumption and asterisk, and we will look at it. So don't get too concerned if you think you've gone down the wrong track. Just say what you've assumed. I think you'll have a lot of fun with that GE assignment.
Okay, so if we go back to the slides... Oh, one more thing.
I didn't tell you the real reason I'm asking you to do the GE assignment. I bought some shares in it myself. I just want to know, are they cheap or dear?
Okay, so if we go back to the slides now, we're going to look at fundamental analysis first. So fundamental analysis is using the financial history of a company as a guide to its future. So we know this isn't always reliable, but it's a good starting point. In Australia, all publicly listed companies need to, by law, release their annual and half-yearly accounts to the ASX and to the market. In the US, this is quarterly. So fundamental analysis is most useful in assessing long-term value in a company, which is why it's typically used by investors. However, fundamental analysis is hostage to the type of accounting measures the company employs. But accounting standards can change frequently, and it means that it can be hard to be consistent and to compare them. Currently, the banking industry is in transition to Basel III, which is a global regulatory standard mainly brought about by the GFC. So changes to the accounting standards can include things like different definitions of accounting items and the inclusion or exclusion of certain items. So if you don't read the notes to the accounts, you may miss something important about what changes year to year. Technical analysis, on the other hand, uses graphics more than numbers. So it is an assessment of past price movements. In any market, often emotion takes charge more than numbers, and when this happens, technical analysis can be beneficial. So technical analysis is handy for short-term investors who want to know when to enter and exit a stock, and it's also known as transactional timing. It's not really reliable for long-term investing. So here we have an example of a share price chart over 3 months. So the blue line is the share price, and the solid green line is the simple moving average, which is the weighted average share price over a previous number of days. In this case, it's 30 days, but you can choose different time periods. So if the two lines cross, this could be a signal to investors. If the green line crosses below the blue line, it shows that the shares were in a declining trend. If the green line crosses over above the blue line, it could indicate a rising trend. And this chart also shows the candlesticks, which are the vertical bars. Green refers to when your opening price is lower than your closing price, and red refers to when your opening price is higher than your closing price. Sometimes you can look for patterns in these indicators. So technical analysis can help us to crystallize a loss before it becomes a large loss. It ignores fundamental analysis and assumes the market is efficient and historic information is already fully absorbed. This can be a dangerous assumption. Typical indicators include relative strength, moving averages, and put-call volatility ratios, which is the implied volatility of put options versus call options. If the call option is rising, the market is what we call bullish, and if the put option is rising, the market is bearish. Technical analysis can be a very useful tool, but we usually don't rely solely on it. So, as I mentioned before, there are two types of investors. There are traders and investors. And so here we show the difference between traders and investors. Traders look at holding a stock for a short amount of time. They are mainly concerned with the timing of their market entry and exit, and they generally crystallize losses early. So traders use technical analysis. Investors, on the other hand, have a buy and hold strategy. They are more concerned with the general direction rather than the exact timing of market entry and exit. By using fundamental analysis, investors buy shares and expect to hold them for a long period of time. So let's do a quick example. Let's say we choose to buy BHP today at $33, and over the next month, copper, coal and steel decline, and so at the end of the month, the stock price is now $23. So now you've lost $10. If you were a trader using technical analysis, what would you do? Who here would sell? Yeah, there's a few hands. Who would hold? Or who would buy more? Or what if you were an investor with using fundamental analysis? So the stock price has gone down 10%. Who would sell? No, and who would buy? And who would hold? So yeah, the people that did put up their hands were basically right. A good trader would have already cut their losses. For example, when they've lost 10%, they would choose to sell. Investors, on the other hand, might not have bought yet after doing their fundamental analysis, and would have bought now that the price has fallen and to a price they're more comfortable with. But if it keeps falling through all your buy prices, you could lose a lot of money. So that means that you really have to make sure when you're doing your fundamental analysis that you're doing it correctly and you've made the right assumptions. And be aware that circumstances can change, and your assumptions are only correct at the time and can easily change. So we actually do have a client who uses a mixture of fundamental and technical analysis. So he will only buy a share if the share price is rising. So if we look now to the process of making a fundamental analysis, this is the start of what your assignment is about. So the first step is to assess the company, the industry, and financial statements. So when looking at a company, we look at the management and the resources of the company. We can also try and go out to the company and meet the management. In the industry, we look at their competitors. We look at industry characteristics, such as if they're capital intensive or vulnerable to new entrants coming in. If there are big costs in setting up the business. Effectively, how is this business making money? We really want to look at the key drivers to the industry, and every company has its own unique drivers. Then we usually make a model of the company. This could be a simple spreadsheet, or it could be a dynamic model with different scenarios, or a statistical model with dynamic inputs. We can then forecast what we think the future profitability of the company will be, depending on the key drivers we have identified. So we can make a long-term forecast on different divisions of the company, depending on input costs and selling prices. There are heaps of things that we can take into account when modelling a company, but be careful that sometimes models can be over-parameterised with too many assumptions. So once we have our model and our forecasts, we can then project the company's future on a range of scenarios and project the forward profits of the company and its cash flows and balance sheet. And having all of that forward information, we can then value the company. There are various ways which we can value a company, which we'll get to next week. There's no real unique answer to evaluation, and different methods suit different companies. And lastly, we have to assess our risks to the valuation. Because we've made a valuation with assumptions, we have to ask ourselves, what are the most dangerous aspects of this valuation, and where could we have gone wrong? Okay, so my next question to everyone is, what are the 3 main financial statements we need to look at? Sorry? Profit and loss. Good. What else? Balance sheet, yep. And the last one? Cash flow, great. And what's the most important one? Anyone want to guess? Yeah, that's right. They're all very important, and we need to use all of them. So next I'm going to go through some ratios which are important. So firstly, why do we need ratios? So the absolute numbers of companies don't always describe the quality of the business themselves. And ratio analysis isn't just comparing different numbers from the balance sheet, income statement and cash flow statement. It's comparing the numbers against previous years, other companies, the industry, or even the economy in general. Ratios look at the relationship between individual values and relate them to how a company has performed in the past and how it might perform in the future. For example, current assets alone don't tell us a whole lot, but if we divide them by the current liabilities, we are able to determine whether the company has enough money to cover its short-term debts. So these are the key fundamental measures we will look at today. Hopefully quite a bit of this is revision for you all, and we'll need it for our example coming up as well. So it's important not to rely on just one financial measure, but to use it in conjunction with the statement analysis and other measures. So firstly we have EBIT and EBITDA, which is EBIT is the earnings before interest and tax, and EBITDA is earnings before interest, tax, depreciation and amortization. So these are important as the level of gearing does not affect these measurements. It's a traditional view of profit that factors in capital intensity. However, it also includes interest income, the company's share of equity earnings, and other recurring non-operating items. EBITDA is the operating profits before interest income, interest expense, income taxes, depreciation and amortization, and asset impairments. So what we want to see here is an increasing trend, and we can also see it as a percentage of revenue. Next we have net profit after tax, or NPAT, which is the company's earnings after tax and all accounting adjustments. And we calculate this as profit minus the tax expense. And again, we want to see this increasing over time. So